So we've all seen them, right? The stock charts, that constant stream of numbers and symbols flashing across the screen. But have you ever stopped to wonder what is actually going on behind all of that? Well, today we're going to pull back the curtain and look at the hidden machinery that really makes the market tick. Let's dive in.
It's the big question, isn't it? The one everyone's always debating. When you see a stock, say IBM or Apple, suddenly jump up or slide down, what's the actual physical force making that happen? Is it just some vague feeling in the market, or is it something much, much more mechanical?
You know, the answer you always get in school is supply and demand. And yeah, on a super basic level, that's true. If more people want to buy something than sell it, the price goes up. Simple. But here's the catch. That doesn't explain how, for every single trade that happens, there's always a buyer and a seller agreeing on the exact same price at the exact same time. The real answer? Well, it's way more interesting. It's a whole system of hidden mechanics we're about to get into.
So here's how we're going to do this. We're going to peel back the layers one by one. First, we'll move past that simple supply and demand story. Then, you're going to meet the most important player in this whole game, the market maker. After that, we'll see exactly how they control the price-setting engine. Look at how a lot of this is just on autopilot. And finally, we'll connect it all back to the charts you see every day.
All right, so first up, let's get beyond that simple textbook definition. The idea of just buyers and sellers is a good start, but it's missing a really crucial piece of the puzzle, a facilitator who makes the entire system actually work.
This quote here, it really gets to the heart of it. For the market to work, the scales have to be balanced. I mean, think about it. A trade just can't happen if buyers will only pay $64 and sellers will only take $65. So who's the one in the middle making sure a match always happens? That's our facilitator.
And that brings us right to our central character, the star of the show, really, the market maker. Now, this isn't just one guy. It's usually a big firm or an institution whose entire job is to be the central hub for trading a specific stock. They literally make the market for it. So the official job description of a market maker is to provide liquidity. And that's just a fancy way of saying they make it easy for you to buy or sell something pretty much anytime you want. How do they do it? Simple. They are always willing to take the other side of your trade. If you want to sell and you can't find a buyer, boom, they'll buy from you. If you want to buy and can't find a seller, no problem, they'll sell to you. Now, this is a huge point. The market maker isn't just sitting there waiting for things to happen. No, they are an active participant. To get the trading volume they need to make money, they are the ones actually nudging the price up and down to encourage people, like you and me, to trade. So what's their motivation? What really drives them? Well, it's not whether a company had a great quarter or a new iPhone is coming out. They are completely, totally indifferent to all of that. Their goal is actually really simple. 1. Keep the game going by creating lots of trading volume. 2. Make a tiny profit on something called the spread. That's the little difference between the price they'll buy from you at, the bid, and the price they'll sell to you at, the ask. And 3. Their main job is to constantly keep those scales of buyers and sellers balanced. They honestly don't care if the price is high or low, as long as people are trading.
You know, the best way to think about it is like a casino in Vegas. The casino doesn't really care who wins or loses at a poker table, right? Its job is just to manage the game, take a small cut of every pot, and make sure people keep playing. The market maker works on the exact same principle. They just manage the flow of buying and selling to keep the market moving, and they collect their little fee on every single trade.
Okay, so let's get into the nuts and bolts. Let's look at this price-setting engine itself. How does the market maker actually use price as a tool to get people trading?
It's actually a pretty elegant balancing act. Imagine there's a flood of people who want to buy a stock, but not enough people are selling. What does the market maker do? It starts raising the price. Why? Because that higher price suddenly makes selling look really attractive, and it tempts new sellers to jump in. And on the flip side, if there are way too many sellers and not enough buyers, the market maker drops the price, making it look like a bargain, which then attracts new buyers. Price is the lever they pull to keep everything in balance.
Let's just walk through that first scenario step by step. So picture this. Some great news comes out about a company and all of a sudden, everyone wants to buy the stock. A huge wave of buy orders comes in. The market maker sees this imbalance and starts pushing up the ask price. That's the price you have to pay to buy. Now, as that price ticks up, people who already own the stock look at it and go, wow, I can sell for a profit I didn't have 5 minutes ago. So they jump in as sellers. The new buyers get their shares, and a trade happens at a brand new, higher price. That line you see going up on the chart, that was this exact process playing out in real time. Now, of course, all of this happens incredibly fast, which brings us to our next section, trading on autopilot. When you hear the phrase algorithmic trading, you probably imagine some super complex, thinking AI. But honestly, for most of what goes on, it's a lot simpler than that. It's really just about computers executing a preset list of rules.
This quote is a perfect way to think about it. You know, solving a Rubik's Cube seems like magic, but the people who do it in seconds aren't geniuses. They've just memorized a set of rules or algorithms. You know, if this color is here, then I turn this side. Market algorithms are exactly the same. They're just a bunch of simple if-then instructions that a computer can follow instantly.
So, to understand the rules, you gotta understand the commands. The most basic one is a market order. This is the I don't care about the price, just get me in or out of the stock right now button. You're prioritizing speed over getting a specific price.
A limit order is the complete opposite. With this one, you are in total control of the price. The command is basically, I will only buy this stock if it's $50 or less, or I will only sell if it's $55 or more. The good thing is, you get your price. The bad thing? There's no guarantee the trade will ever happen if the market never hits your number.
And here is the one almost everyone gets wrong, the stop trigger. Okay, the most important thing to remember is that a stop is not an order. Say it with me, not an order. It's a trigger. It's a condition. You just tell your broker's computer, hey, watch the price. If it drops to $48, then, and only then, send in a market order to sell. The stop is the if, and the order it sends is the then. It's just a tripwire.
So this table breaks it down perfectly. A market order gets you in right away, but you have zero control over the price. A limit order gives you total price control, but you might not get in at all. And a stop isn't even an order. It's just the trigger that, once it's hit, launches one of the other two types. These are the simple building blocks for all of that automated trading.
So here's a super simple real-world example of how it all works. A trader can just type a rule like this into their software and literally walk away from the computer. The program will watch IBM constantly. The very second a trade happens at or below $195, it automatically triggers and sends that sell order. That's really the core of most algorithmic trading. It's not thinking, it's just following instructions.
Which brings us to our grand finale, the chart's hidden story. Because now that we understand all the pieces, the market maker balancing things out, the automated orders firing off, we can finally look at a stock chart and understand what we are really seeing.
The name for studying charts is technical analysis. Now, the official definition is the study of price action over time, but honestly, a much better way to think about it is just as the body language of the market, right? Just like you can tell how someone is feeling by their posture and gestures, you can see the collective mood of all the buyers and sellers just by reading the story the price is telling on the chart. And this, right here, is the final crucial piece of the puzzle. Every single peak and every single valley on that chart, what traders call swing highs and swing lows, that's not random noise. Every one of them is a footprint. A swing high shows you the exact point where the market maker had to raise the price high enough to convince sellers to show up. And a swing low is the point where they drop the price low enough to tempt all the buyers to rush in. The chart is literally a historical map of this hidden engine at work.
So the next time you look at a stock chart and you see that price start to move, you won't just see a line going up or down anymore. You'll actually see the market maker doing its job, pushing and pulling the price to keep the scales in balance. You'll see thousands of little if-then rules getting triggered all at once. You'll be reading the body language of the market. So the question is, now that you can see the machinery behind the curtain, what story will you see in the next move?